All right. Today is Monday, June 28th. This is a recap for the stock market activities today. Ladies and gentlemen, it has been a choice between two roads for the stock market at least since last year, 2020. And during last year, we were hit with the worst pandemic crisis in over a century, causing a massive economic recession, meaning bad news. Now, the market, specifically the growth and technology side of the market, loves bad news because bad news ensures that the accommodation from the Federal Reserve will remain on the table, meaning lower interest rates and the assets purchasing programs. This has been the story last year, and therefore we saw lower Treasury yields, and we saw tech, stayed home, and growth stocks rising significantly higher. Matter of fact, this has been the story since the last financial crisis in 2008. The Fed's accommodation has been the leading story of investing in the 2010s. In essence, the Federal Reserve acted as a traffic cop for every single penny of capital across the country, a matter of fact, across the globe. Every single pension fund, every single hedge fund, every single retirement fund has to follow the traffic direction by the Fed. And the Fed, by doing quantitative easing, keeping interest rates low, and buying assets, specifically bonds, to keep those yields and interest rates as low as possible. And by doing so, the Fed, aka the traffic cop, directed every penny of investment away from bonds and other assets and into the risk on equity markets, specifically the tech, high growth, and high multiple names. And it is very simple, folks. You don't have to have a financial degree to figure this out. If the future is projected to have lower interest rates, then you don't want to invest in assets producing cash at the present time because the future value of present earnings gets diluted. On the other hand, you want to buy the high multiple technology names, speculative assets valued based on future earnings, because if the future is projected to have lower interest rates, then the value of future earnings is amplified in the present time because today interest rates will be higher than 2 years from now. So every single penny of earnings the company is projected to make 2 years from now is valued at a higher value today than 2 years from now. Likewise, if a company produces cash today, this cash will worth a lot less 2 years from now. And therefore, the Fed acted as a traffic cop, directing cash all the way to technology, high multiple, and growth stocks. And indeed, it has become the growth era. We saw companies like Amazon, Netflix, and many of the software stocks having excellent stock market performance, even though these companies have not been profitable for many years. And the reason is the flow of capital by the Federal Reserve, allowing these companies' equities valuations to rise significantly higher based on future prospects. In the meantime, these companies were able to use their elevated equities values to secure debt funding, and perhaps being more able to absorb losses today and therefore becoming more competitive in their respective markets. So companies like Amazon, for example, even though not making profits for years and years and years, but the stock continued to go higher and higher and higher. And now you know why. Due to the Fed acting as a traffic cop. Amazon using the elevated stock market equities value, securing debts all over the place, being able to price out the competition because Amazon can afford losing, and yet its equity value continues to rise higher and higher and higher, and therefore destroying mom and pop's businesses across the country due to underpricing and using all of that debt to expand on the expense of mom and pop businesses. And now fast forward, Amazon is indeed a profitable company. That wasn't possible without the Federal Reserve's policies. So, in essence, every money manager across the country, including myself, knows the following. When the expectations are for more Fed accommodation in the future, you choose the high growth, technology, and now the stay-at-home names, because the Fed is projected to be more accommodative due to bad news, and hence bad news is good news for growth investing. But then what happened as we started to move closer to 2021, specifically right after the election of Joe Biden here in the United States? The picture of vaccinations became clearer. The optimism that the worst is behind us regarding the virus started to spread, and the Fed pushing for more inflation to amplify the economic recovery was underway. And therefore, we shifted from the era of bad news to good news. We actually started hearing good news regarding the economic recovery and receding infection rates due to the success of the COVID-19 vaccines. This good news shifts the expectations of Fed accommodation in the future, because if we have good news and inflation is rising higher, then we will reach a point where we need less Fed accommodation, not more. And therefore, that ignited the shift in the dogma of investing from growth investing back into value investing. And so far in 2021, this year, we saw value, reinflationary, and reopening stocks leading the market higher and outperforming growth stocks. This is at least until June 16th, right after the Fed's decision. Heading into the conference, we knew that inflation is rising significantly higher and there is a powerful economic recovery underway. Perhaps inflation is getting too hot to the point where it started to stagnate economic activities. So when the Fed came out and said, you know what, inflation is rising significantly higher, the majority of this rise will be transitory. But anyhow, we're going to take a hawkish stance here and push the outlook of raising interest rates, meaning less accommodation from the market, a little sooner than expected. And the market understood right away that the Fed is turning more hawkish. The Fed is inching closer to tapering, and therefore we saw yields pushing higher and the dollar index popping higher. But then we witnessed the taper tantrum, and it came in an unexpected way, by the way, because bond investors decided to do the following. They decided to buy bonds aggressively, pushing yields down while pushing lower end yields higher. We talked about the yield curve moving from steepening to flattening, and that is an indicator that the near growth picture in the economy will be a lot better than the long-term growth, meaning today will be better than tomorrow. As if the bond market is warning the Federal Reserve, if you go ahead with your plans of increasing interest rates sooner than expectations and therefore pushing tapering sooner than expectations, then what you will do is a significant slowing down of the economic recovery underway. The Fed immediately retracted the hawkish stance and came out last week saying forget about Bullard, forget about Kaplan, just listen to Jerome, Clarida, and New York Fed President Williams, who spoke today, by the way. Listen to the doves. Did we say we're going to raise interest rates sooner than expected? We misspoke. We're not going to do that. We're just going to be data dependent. Okay, so the tantrum is over, the Fed is retracting, and the 10-year yield is pushing higher once again, which means going back to pre-meeting. Well, if that is the case, then the assumption is we're going to go back to the inflationary trade of industrials, financials, energy, materials, as yields start to recover higher. But this is not what we're seeing so far. We're seeing the bad news trade of lower yields, tech, stayed home, and growth stocks outperforming. And now this is floating a new theory of what's going on in the stock market right now. Because even if the bonds market is playing this cute trick, throwing a tantrum, saying Fed, don't taper, but we're going to act as if you're going to taper anyways by keeping yields down and going back to the tech stocks, the problem is that tapering is bad for the entirety of the market, not just the inflationary stocks. And therefore, this is floating a new theory that the market is shifting to the deflationary mode, the bad news mode, back again, because the market is looking forward and it is seeing legitimate bad news on the horizon. A legitimate slowdown in the economic recovery that will ignite the discussion for the Fed to keep the accommodative policy for longer than expected. So forget about tapering. Forget about raising interest rates. We're now talking about the Fed extending its accommodative policy. Why is that? What is the bad news that the market is seeing when it looks forward? And this is according to this theory, by the way, not according to me. Here it is, the Delta variant. The new black swan that will invade the market, slow down the economic recovery and perhaps ending the economic recovery, at least according to the action in the stock market. And the debate I want to ignite from this program tonight is, hypothetically speaking, assuming that the market's reaction so far is indeed due to the fact that it looks forward and it is seeing the Delta variant being an extreme negative element that will head the economic recovery underway. Do you believe that the market is right, or do you believe that the market is over-exaggerating the possibility of the Black Swan event? But so far, here's what we know. We're reading headlines like this. Gottlieb says parts of the US could see very dense outbreaks as the Delta variant spreads. Here's another headline from the Los Angeles Times. The new Delta Plus coronavirus variant has been identified. What does that mean? Here's another headline. Delta coronavirus variant infects all unvaccinated guests at Australian birthday party. Here's another headline from the Wall Street Journal. Delta variant outbreak in Israel infects some vaccinated adults. Here's another headline from the World Health Organization, the WHO, recommending wearing masks even for vaccinated people due to the new Delta variant. Here's another headline. Boosters may be needed for the J&J shot as Delta variant spreads. What does this sound on face value? It sounds that we should start shitting our pants because we have a new variant of the virus that will bring back shutdowns, restrictions, masks wearing, and slow down the economic recovery underway, if not kill it entirely. And this is what we're seeing in the market right now. Carnival Cruises, the poster boy stock for the reopening, crashing today with losses of about 7% in a single day. Meanwhile, the poster boy for the stay-at-home stocks, Zoom Communications, rising by the tune of over 4% today. So the message for now, at least, according to this theory, that the market is reverting back to the playbook of 2020 due to the looming danger from the Delta variant to the economy. Now, for the time being, I am not a subscriber of this theory unless the Delta variant becomes a death sentence that manages to evade the current vaccinations from Pfizer, Moderna, etc. Absent of that, I'm not a believer that the Delta variant will be a big problem, prompting another shutdown of the economy. I think, number one, people will not accept another shutdown, and the country cannot afford shutting down again. That will be an economic catastrophe. I believe the following. The market is following the playbook of low volume where algos take the driver's seat in trading, doing so by following the technicals. And the technicals say yields down, tech, momentum, high growth stocks go higher, while banks and inflationary stocks go down. The bond market sends the signal for the stock market, and the stock market reacts. And looking at the 10-year treasury, for example, every pop magically evaporates right away. And we see a harsh reversal for any pop in the 10-year treasury yield. And we know why. We know who's manipulating yields so far. Because we have the highest CPI number since 2008. We have the highest PPI number, the Producer Price Index, the highest reading on record. And then we got the Fed's favorite, core PCE inflation, and that came out as the highest reading since 1992. But the Fed is quote-unquote winning the narrative, or at least faking the appearance of winning by manipulating the bonds market. Winning meaning the transitory argument. The Fed says, don't worry about the CPI, don't worry about the PPI, and don't worry about core PCE either, because all of this is peaking and it is transitory. Trust us. And we see yields dropping down, creating this illusion that the market believes the Fed's argument that inflation is transitory. The Fed says pay no attention to the actual inflation data because they're peaking and they're transitory. CPI, PPI, core PCE, what does it matter? Doesn't matter at all. What we're watching is the pace of jobs creation. This is what the Fed says you have to shift your focus to. Forget about inflation data. If you want to know when we're going to taper and raise interest rates, watch the recovery in the jobs market. And that makes the non-farm payroll report we're about to get this Friday one of the most important numbers to watch. Because what happens if that number comes out hot? and the economy all of a sudden created a million or perhaps more than a million jobs last month. And now we have to look at the Fed and say, what now? What are you going to do now? You've been waiting for the pace of jobs creation to go higher to spark the tapering discussion. Well, now you have the inflation data going higher along with jobs creation, and then the market will start to reshuffle and rotate once again. So, in a nutshell, I believe that the market is following the signal from the bonds market. The algos are following the technicals and trading the market accordingly. For now, I don't believe that the action we're seeing in the market, this rotation back to the bad news mode, is due to the market's legitimate concern of a black swan event arising from the new Delta variant. At least for now, given the information I have right now, I don't believe that. I believe that the market has been following the lead of the bonds market, and that could change as soon as we get the report on Friday. Again, long intro, but we need to understand the market's dynamics. And with that, let's start the market coverage by looking at how the market did today. And here we go. The Dow Industrial Average closing in the red, down 150.57 points, or a decline of 0.44%. The Nasdaq closing in the green by 140.12 points, or a gain of 0.98%. The S&P 500 closing in the green by 9.91 points, or a gain of 0.23%. What about the sector's performance today? Leading the pack at number 1 and capturing the gold medal, technology. At number 2 for the silver, communication services, aka Facebook. And at number 3 for the bronze, utilities. Meanwhile, the laggards of the day led by energy down big today, financials and industrials. The inflationary trade not working today. What about beneath the surface? The advance to decline ratio for the market. NYSE, 26% advancing versus 72% declining. Wow. On surface, the market closed in the green, but looking under the hood, this is absolutely terrible for the New York Exchange today. What about the Nasdaq? Leading the day, closing with gains of over 1% today alone. But looking under the hood, the details, only 40% of stocks in the Nasdaq were advancing today versus 57% declining today, meaning that the move higher in the Nasdaq came on the back of very few stocks, but the entirety of the market was not doing that good. Moving on to futures, starting with crude oil. We saw declines for the WTI with a little over 1.5%, but losses of about 2% for crude oil Brent. And that led energy stocks down. You saw massive losses for Exxon, Chevron, BP, and the likes. What about softs? We're seeing gains led by coffee, lumber, sugar, and cotton futures. Meanwhile, leading the losses today, OJ futures. On the other hand, we have coca futures flat for the day. What about metals? Rebound for palladium to the tune of over 2%, and we saw modest gains for silver and gold futures. Meanwhile, modest losses for copper, yet sizable ones of about 1% losses for platinum. What about meats? Big rebound for lean hogs futures, with gains of about 3% today. Meanwhile, we saw losses for both feeder and live cattle futures. Lastly, what about grains? Massive rebound for corn, gains of about 6% today. We also saw soybean oil, oats, soybean, wheat, and soybean meal futures rebounding higher as well. Meanwhile, canola futures leading the losses in grains today. Moving on to the big casino, the options market. Let's see what's going on here. Leading the tables at number 1, Apple, with about 1 million contracts traded today. About 78% of those were calls. At number 2, AMC, with about 800,000 contracts. About 67.5% of those were calls. At number 3, Tesla, the souffle, with about 700,000 contracts. Only about 39% of those were calls. They continue to bet against the stock, but it continues to rise higher. Even though we have bad news for the company, by the way. But we also saw significant uptick in activities for NEO, Facebook, Alibaba, Viacom. These names are sort of rising from the dead here, and we are seeing more bets using options for these names. What about the unusual activities taking place in the options market today? starting with the ticker CCL, one of the biggest losers today. And of course, the explanation is the Black Swan Delta variant event. Whether that's going to stick or not, that remains to be seen. But CCL getting whacked today and somebody's bidding for more declines to come by buying the 24 puts expiration date July 16th with expectations that the name will drop by over 8% by then, and they paid about 35 cents a piece to enter this trade. All in all, bringing the total to about $500,000 or $500,000, whatever you like. What about the trade for the ticker DVN? This is for Devon Energy. It was one of the biggest losers today along with CCL, but somebody's betting for a rebound here in DVN by buying the 30 bucks calls expiration date July 30th with expectations that the name will rise by over 5% by then. They paid about $1 a piece to enter this trade. All in all, bringing the total to about $1 million. What about the trade for the ticker IGT? Watch out for this name. It could be the next one to move higher because they're buying the 25 calls expiration date August 20th with expectations that the name will rise by over 5% by then. They paid about $1.30 a piece to enter this trade. All in all, bringing the total to about $1.3 million. What about the trade for the ticker SPY, the S&P 500? They're buying the 400 puts expiration date August 20th, expecting the SPY to drop by over 6% by then, and they paid about $1.75 a piece to enter this trade. All in all, bringing the total to about $1.7 million. What about the trade for the ticker SCHW? This is for Charles Schwab. We're seeing the financial stocks moving higher after hours, right after the announcement from Morgan Stanley by doubling their dividends and stock buybacks. And this was expected because the Fed gave the green light for financial institutions to reinstate stock buybacks and increase their dividends after the Fed's stress test. And perhaps Charles Schwab will start to announce similar plans, and therefore they're buying the 80 calls expiration date August 20th. With expectations that Charles Schwab will rise by over 9.5% by then, and they paid about 75 cents a piece to enter this trade. All in all, bringing the total to about $600,000. What about the trade for the ticker BYND, Beyond Meat? They're buying the 170 calls expiration date July 2nd, meaning this upcoming Friday. And they paid about $1 a piece to enter this trade, all in all bringing the total to about $800,000. Lastly, what about the trade for the ticker FB, Facebook? One of the biggest winners today. And the reason is a judge ordered the FTC lawsuit against Facebook to be dismissed due to technicalities. Here in California, we have estoppel laws with an E. These are the equivalent of a waiver, meaning that the acquisition of Instagram by Facebook happened years ago, and the FTC did not sue back then. So why are they suing now? By doing so and not protesting the first time around when the acquisition happened, the FTC waived its right to prosecute Facebook. And this is how the court saw the case. Anyhow, that impacted Facebook shares positively. And by the way, before the news was out, we saw massive elevation in call options buying. All of a sudden, who's leaking the news? Who knows the news ahead of time? Because they've been buying call options since the morning. And this is one of them. They bought the 375 calls expiration date July 9th. With the expectations that the name will rise by over 5% by then, and they paid about $2 a piece to enter this trade. All in all, bringing the total to about $1.5 million. What about the heat map activities? Right away, looking at the heat map, you see the pain in the inflationary side of the market, specifically energy stocks, leading the declines today along with industrials, financials, and materials. What's outperforming is technology, stay-at-home, and the high multiple names. We're seeing names like Neo, Tesla, Twilio, Pinterest, Zoom, Palantir, Square, all moving higher. And the buying is happening for these individual names, but mostly via buying the ETFs. And this is, by the way, how you know that this is algorithmically led trading, because the algos buy the ETFs, and they decided to buy the triple Qs today, pushing Apple, Microsoft, Amazon, Facebook, Google, all trading higher today based on ETF buying by algos. Likewise, when you look at the semiconductor names, both the value and the growth names rising higher together. which is not the typical performance we have been seeing for the last few weeks. What does that say? It says that the buying was due to ETF buying. In this case, the SMH or the SOXXX. Once again, the algos buying semiconductor ETFs, pushing everything higher, whether we're talking about Texas, Qualcomm, Intel, even Nvidia, AMD, AMAT, all rising higher today. And this is why I want to caution from this theory. The money managers are shifting back to technology and growth once again. Not true, at least not from my contacts. Some are moving some capital back to tech, specifically the names that have been stagnating since last year. Apple, Amazon, Netflix, etc. But they're now moving away from the inflationary trade altogether, and therefore you have to take the market's action with a grain of salt. For now, all we know, the market is following the technical signals from the bonds market. Whether the black swan event theory, the Delta variant theory, starts to gain steam in the next few days or not, that remains to be seen. But for what we know right now, the market is following the technical signals from the bonds market, which the Fed is manipulating, by the way. What about the themes analysis, starting with the reopening trade? Losses across the board when yields drop down and the prospects of the economic recovery and the reopening are tampered, whether due to the action in the bonds market or whether it is actually a legitimate fear from the black swan event. It doesn't matter. Yields go down, reopening optimism goes down, and these names also following the move to the downside. The exception is AMC, but this is a meme stock involved in a different game. What about the inflationary trade? Trading to the downside as expected, yields going down, and we're seeing more negativity as if the market is riding the bad news program once again. We're not seeing significant losses, by the way. The trade was just out of favor today. No massive sell-off as if money managers are shifting away or rotating away from these stocks, at least not yet. What about deflation stocks? Leading today's gains, and the reason is yields went down in the morning, a massive sharp reversal to the downside, and that ignited algos to buy the Nasdaq, the high multiple names, and revert back to the growth trade mode. Moving on to the charts analysis, starting with the SPY 30 minutes chart. What's going on here? Trading above the last resistance level of 425.45. What does that mean? It means that the sky is the limit. And it looks like the SPY and the market in general is entering this low volume gap higher overnight mode. And we know that that could produce sizable gains. It could be a massive rally higher, but it always ends with a sharp, massive reversal to the downside. So are we going to see the series of gapping higher again? We'll see. But remember, this will be an important week for the market, and the reason is the non-farm payroll report. The Fed says forget about the CPI, PPI, PCE, that doesn't matter. Watch out for the jobs report. If it comes out too hot, we could see a reigniting of the inflation risk discussion back to the market, and then the volume will come back. What does that mean if the volume comes back? Here's what I mean. The daily chart of the futures, the continuous contract of the S&P 500. Watch the lower divergence in the volume. The volume receded significantly, and therefore the market continued to march higher, gapping overnight, which means that if the volume spikes higher once again, that will be accompanied by a move to the downside, not the upside. For now, for all we know, the momentum indicators, the MACD and the RSI having a positive divergence, a moving higher. No stop in sight. The momentum is strong. The chart is trading above the last level of resistance, 4,232. For now, all is clear. The sky is the limit. But the danger comes if the volume creeps back into the market. What will be a catalyst for the volume to reignite and spike higher in the market? Perhaps a reaction in the bonds market to the non-farm payroll report we're about to get on Friday. This is at least what I'm watching for. The volume is extremely important to watch. What about the cues? 30 minutes chart, similar story here. Volume is down, the market is gapping higher. Overnight, the last level of resistance is far beyond, now becoming the support of 344.5. What does that mean? It means that the sky is the limit. You ride this wave, you don't fight it, but you have to watch out for the volume, because if the volume comes back, the picture will change. And here it is, the daily chart of the continuous contract of the Nasdaq. For now, the momentum indicators are becoming extremely strong. Yes, they're becoming extended, whether we're talking about the RSI or the MACD indicators, both becoming overextended. But it's a fool's errand to start picking a top right now. It can get even more overextended. For now, all what you have to do is to start booking profits and look for a reversal signal. Watch the negative divergence in volume. The reversal will happen if the volume starts to reverse higher. The volume will reverse higher, sparking the Nasdaq to go down. What will be the catalyst for that? Perhaps a reaction to the bonds market. If yields start to rocket higher again after we get the jobs report on Friday. For now, ride it. Don't fight it until you get the reversal signal. What about small caps? The IWM 30 minutes chart. We had the reconstitution, aka the reconstruction of the IWM on Friday after hours. The expectations were that the IWM will be sold due to the reshuffling of names within the index. Lots of names will be sold first, and then some names will be added. That sell-off, however, came late in the day on Friday. The IWM was trading higher by the tune of over half a percentage point throughout the day. And then the last 10 minutes of the day, we saw a massive reversal to the downside, closing at the flat line. And today we saw the continuation of the move from last Friday, the sell-off of the IWM due to the reconstitution. However, we saw a bounce in the IWM today around the level of 229, which I am identifying for support because we have seen multiple reactions at this level to 29. Is this it for the sell-off? For the reconstitution of the IWM? That could be the case, but for now, this is a negative formation, not a positive one. What about the Dixie, the dollar index? Not backing down by any mean. Matter of fact, it is consolidating just underneath 92 once again. As if to say that the Dixie is not done moving higher yet. Until I see drop down all the way to 91, the US dollar is not done popping yet. Of course, there is the obvious that we saw a reversal and now we're consolidating in a bear flag formation. Well, that bear flag better play down as soon as possible. Otherwise, if we get more consolidation underneath 92, that will actually signal that the Dixie is preparing for a move higher, not lower, and therefore making gold looking ugly for the moment. Gold also has a bear flag consolidation, but this one is clearer than the US dollar. This comes after a massive flush down from the highs. And we have the level of 1750, the Fibonacci retracement level, around the number. This is not precisely the exact number, but this is a bear flag consolidation, and the assumption is that we will see another leg down as soon as the US dollar props higher. So is this going to play out as we expect, the US dollar propping higher, gold dropping down, or are we going to see the surprise? Gold popping higher in reaction of the US dollar dropping down. And if that happens, some of the technical analysts will attribute that to the bear flag, the mini bear flag in the US dollar. And here it is. What about yields? The 10-year Treasury yield. We have one of those mysterious reversals. Right after we see a pop in yields, magically, we see a 180 right away, as soon as the market shows any signal and any sign of nervousness. And this is no different. Overnight, yields started to move down because somebody started buying bonds. Yields moving down, that ignited the Nasdaq futures to react higher. Meanwhile, Dow, the inflationary stocks futures, went down. So for now, we're seeing this algorithmic relationship between bonds and stocks. The $1 million question is, can the Fed keep the lid on the yield curve, pressuring yields, specifically on the higher end, downward? Or do we trust the economic recovery underway, which says that perhaps the number will be higher, more jobs recovered and created due to the reopening of the economy? And if that is the case, are we seeing a resumption of economic activities higher along with higher prices, that inflation comes back in the table along with tapering, and the bonds market will start to react differently? What about the VIX? 4 hours chart. The VIX is consolidating after a move to the downside. And the question is it done moving to the downside, or is it just taking a break before resuming with another leg downward? Reaching 15 now. How low can it get? Back to 12? And if that is the case, then you buy the VIX with both hands, because that will indicate that we're seeing a last hurrah rally in the stock market before entering another sharp correction. I don't believe that we're going to go to 12 before we pop higher and visit 18 once again. And remember, when we talk about rotating from one side of the market to the other, that pretty much makes it impossible for the SPY to go down. So the VIX will not pop higher until the SPY goes down altogether. No picking and choosing or favoring one side of the market over the other. For now, we don't see this dynamic changing. The bipolar market, the market keeps shifting from one side to the other, and therefore that makes the appetite of buying volatility and buying the VIX disappear completely. What about Apple, the big kahuna? We saw a massive pop higher in the morning. This is the 30 minutes chart, by the way, and now the chart's consolidating underneath 135 in a bull flag formation. Now, before we saw the move in the bonds market in the morning, prompting Apple to skyrocket higher, the picture was looking as if Apple was running out of gas. We saw the gap and crap, and we started to see negative divergence in the RSI indicator. And that was a signal that the stock is perhaps going down to catch the support of 131 first. And I made a bid for that particular scenario, where now we're seeing the opposite happening, with Apple popping higher. The negative divergence is gone, and the chart is trading in a positive technical formation. What does that mean? You gotta abandon the trade. You don't fight it anymore. Once the thesis is defeated, you have to exit the trade and move to another winning trade. The last thing you want to do is being emotionally attached to any single trade. For all I know, for whatever reason, the bull flag doesn't work out and Apple goes down again, and indeed it revisits 131. But I'm not going to play this game, because once my thesis that I entered the trade based upon is defeated, we move on. And I hope you do the same thing too in your trading, because being obsessed of being right rather than the thesis playing out is a dangerous recipe for losing money in options trading. What about Tesla, the souffle? What's going on here? We saw the massive pop higher once the 629 resistance level was defeated. And now Tesla's consolidating in the next very important resistance level of 679. It's going up and down, back and forth, consolidating around this number, 679. We are seeing increasing bets buying puts against Tesla. But for now, the momentum indicators are in sharp positive divergence, and they're not finished yet. You don't want to bet against the stock with strengthening momentum indicators. You want to wait for the reversal signal to happen first, and then you bet against the name. For now, you ride the wave higher. And if the wave is about to ride higher, and the expectations are that Tesla the souffle will break above 679 and visits the next resistance level of 720. Until and unless we see a reversal signal, this is the projected scenario. What about the tulip market? What's going on with BTC? Over the weekend, I gave you the number 35,750. Now, being more conservative here by picking a higher number, the actual number is a little down, but it doesn't matter because this is the exact zone where BTC is fighting resistance. It went all the way there, reversing to the downside, going all the way back to 30,000 once again, the must-keep level, and bouncing higher. And now it is battling the same resistance level once again. Will it be successful in blasting above that level or not? We are watching the momentum indicators. We have a mini slight positive divergence in both the RSI and the MACD indicators. If they play out, we would see a massive pop once BTC breaks above 35,750. However, if BTC starts to stall again, losing momentum and getting rejected from 35,750, the next move will be all the way down to 30,000. And what about meme stocks? Let's talk about memes. Starting with AMC. We talked about the gamma squeeze phenomena. If you want the stock to move higher and experience a gamma squeeze throughout the week, you need to pop the stock higher Monday and Tuesday. When we saw the opposite happening last week, with AMC going down on Monday, I said this will be a bad week for AMC, and indeed it was. This week is starting with a 180 picture, popping higher on Monday, and the level to watch here is the 60, because watching the options grid, the open interest for the 60 calls expiring this Friday is about 11 to 12,000. If the stock starts to trade above 60, say by tomorrow or Wednesday max, the stock has to be trading above 60 by Wednesday maximum. Because if that happens, the market makers will say we have to buy the stock now because it will be trading above 60. And rather than waiting all the way to Friday before buying the stock at a higher price and deliver it for $60 a piece to whoever want to exercise these options, the market maker starts to buy the stock right away. And that creates the gamma squeeze that we usually see on Thursdays and Fridays. Here's another meme stock, the ticker WISH. Do we even care what this company is all about? Of course not. We just care about the ticker, and the ticker is WISH. Wish. Now, the momentum indicators are getting overextended in this name, specifically the RSI. We also have a very important resistance level of 15, from which the chart was supported at least once and then rejected at least once. And that makes 15 extremely important. And you saw the chart facing resistance at 15 at least today. It has not reversed from 15. It hasn't been rejected yet, but we are watching 15 because a break above 15 will ignite a massive move to the upside. And that is supported by the action in the options market. The 15 calls have over 17,000 open interest, meaning if the stock breaks above 15 by tomorrow and maintaining that level on Wednesday, market makers will scramble to buy the stock, and that will create a gamma squeeze to the upside. So what are they going to do starting tomorrow? They will try to push the stock below 15 by selling whatever shares they have right now, because the last thing they want is for the stock to go all the way to 15, and now they have to get gamma squeezed once again. Here's another meme stock, CLOV, Clover, reaching the resistance of the Fibonacci retracement level and reversing all the way down to close the gap at 1260. And this is the most important level to watch. For now, CLOV managed to bounce higher after closing the gap. Will the move higher continue tomorrow? Because if it does, then CLOV will move higher. Now, if it doesn't, the stock will go significantly down. And the reason is it is not supported, at least for now, from the activities in the options market. The highest open interest for expiration Friday happens to be at 15, with about 8,700 contracts open. The stock for now, keyword for now, trading way below this number, making the risk of a gamma squeeze less likely than other meme stocks. Speaking of, here's another one. The ticker PSFE, PaySafe. This is a 4 hours chart. Who cares what the company does? We want the ticker. It is PSFE. We have a descending line that was broken to the upside. What does that mean? It means that perhaps the squeeze in this name is not over yet. It is just starting, which make it a better candidate for a gamma squeeze. And I actually bought call options for this one today. When you look at the options grid for PSFE, you see a massive open interest at the 12.5, 14, and 15 levels, meaning if the stock starts to trade higher above 12.5 starting tomorrow, we will see market makers stampeding to buy the stock, igniting a gamma squeeze in this name. They will try first to push it down below 12.5. If they fail to do that, then we will see a massive gamma squeeze in this name. What about Workhorse, the ticker WKHS? This is a weekly chart, and I happen to be in this trade, by the way. It is the only meme trade that I have along with PSFE. Now, we talked about this stock before. It is consolidating within the shorting zone, where the shorting happened in this name. It is still in the lower edge, but if it starts to move to the middle ground, surpassing 20, we will see the shorts scrambling to cover and book some of the profits, whatever is left on the table before they turn into losses. The motivation for closing your shorts when a stock is already trading way above, like AMC, for example, and you know that this is a short-term squeeze and the stock will go down, flushing down significantly. That actually motivates you to meet your margin and even short more, because you know that the stock will drop down significantly after the squeeze is done. But when you have a stock where you're still sitting on gains because you shorted the stock at 30, 32, 28, and the stock starts to creep higher, and you're seeing what's going on around with the short squeeze phenomena, you're more motivated to book whatever gains you have right away, igniting the short squeeze rather than waiting, holding your ground, and short even more, betting that the stock will reverse to the downside once again. Therefore, I believe that this stock right now is the best candidate for igniting a short squeeze rally. For now, all of them been gamma squeezes. We haven't seen a short squeeze yet. And by the way, Workhorse has the 17, 17.5, and 18 calls, all with elevated open interest, suggesting that this is a good candidate for a gamma squeeze. They're going to start to push these stocks down from these numbers I gave you starting tomorrow. They want to avoid the gamma squeeze scenario first. If they fail, then they will stampede and create the gamma squeeze higher. And understand, these are lottery tickets. You're not going to invest your retirement account. You're not going to take your student loans. You're not going to take any loan, for that matter, to buy AMC, Workhorse, any of this garbage. These are lottery tickets. They are trades, not investing. Don't ever forget that. Lastly, moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the S&P Core Logic. This is the Schiller Index, and that will be important for the real estate market. And it will be an indicator, by the way, for inflation, at least in housing prices. And then we have Barkin speaking. Who cares? It's another dove, another propagandist. They're letting Williams and Barkin speak this week. And then we have the Consumer Confidence Index. And we already know how that will go because we got the University of Michigan consumer sentiment on Friday. And while the poor and the middle class are starting to worry about inflation driving down their consumer sentiment, the wealthy could not be any more confident. The sentiment are reaching all-time high for wealthy Americans. Surprise, surprise. Real estate values are going higher, and the stock market is going higher and higher and higher. Anyhow, this is not the most important day from a macroeconomics perspective. The most important date will be Friday due to the non-farm payroll report. Anyhow, that's all I got for you tonight, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.